Hello everyone and welcome back to Fun with Fitzy. Today's topic is 2.4 and we're going to be talking about GAAPs versus IFRS. Alright, let's start off with what is GAAP, or what does GAAP stand for? GAAP stands for Generally Accepted Accounting Principles, and these are the rules or guidelines that accountants previously in Canada would follow to help things be consistent. These rules, it was kind of like a rule book for a sports team. The rules were made by the Canadian Institute of Chartered Accountants, CICA here, which is no longer in existence. As you know, the Chartered Accountants have amalgamated with the Certified Management Accountants and the Certified General Accountants, and they've all now merged to become CPAs, or Chartered Professional Accountants. GAAPs were put in place to ensure that all accounting practices were coherent and consistent. This means that all accountants would be following the same procedure, so that if I made a balance sheet or you made a balance sheet, our balance sheets would be the same for the same company. It also provided structure for accountants to respond to issues. So if something came up that was out of the ordinary, it would give you somewhere to look for reference as to how to handle that situation with respect to accounting. And these four things here: relevance, reliability, understandability, and comparability, are four important things that were held up because GAAPs were in place. So let's look at each one of those things individually. First, understandability. What we mean by understandability is that anyone with a little bit of knowledge or willingness to study the information would be readily able to understand it. So, for example, anyone with a little bit of knowledge about accounting could look at a financial statement and understand it. They would be consistent from company to company. Relevance. Relevance means that information is relevant when it influences the economic decision of users. So certain things needed to have rules in place so that all accountants would follow the same rule book, so that the outcome or net income or net loss of a company, everyone would be using the same practice. Or if you changed a practice, you would let everyone know about that via notes in financial statements. The information basically is relevant to the person who is looking at it. Also, the third thing is reliability. We want to make sure that all of the information when looking at financial statements is free from errors or personal biases. Basically, it is based on objective evidence. Okay, and that everyone who is looking at it could depend on the information to be accurate, let's say. And comparability is the fourth thing that GAAPs ensured. Comparability meant that users would be able to compare two different financial statements of two different companies, let's say, or the same company over time, and that transactions or certain business practices were handled consistently from one period to the next. Okay, so rules put in place just so we could understand the financial statements when we're looking at them. The information is relevant to us. We know that it's reliable, and we can compare them. All right, where does IFRS come into play then? So IFRS, first of all, it stands for International Financial Reporting Standards. They are a set of international accounting standards that state how particular types of transactions and other events should be reported in financial statements. So very similar to the GAAP. GAAPs were Canadian rules set in place by the Canadian Institute of Chartered Accountants, whereas IFRS now are the international rules. Canada used to use GAAP, and then January 1st, 2011, what that means is any publicly traded company, and what a publicly traded company is a company that sells shares on the stock market. For example, the Toronto Stock Exchange or the New York Stock Exchange. Any companies that are selling their shares publicly Nike, McDonald's, companies like this, if they were Canadian based, they had to use IFRS. They had to switch from GAAP to IFRS. So in this course, we're going to learn both IFRS and GAAPs, and we're going to look at the similarities and some differences between them. And the reason why we're going to look at GAAP still is because in Canada, companies that are not publicly traded, small sole proprietorships, private corporations, they still may use the GAAP principles and rules. So there are several different GAAPs and IFRS that I'd like to go through here in this course. There are 9 that I'd like you to know in this course. There are many, many, many more. We're talking books that are 3 inches thick in some cases of rules for accountant. But really, we're just going to cover the basics. So the first one is around the Canadian GAAP conservatism. The principle of conservatism, it's called. Okay, so the principle of conservatism states that accounting for a business should be fair and reasonable. Basically, accountants were required to make judgments based on procedures that will not overstate our profits or understate our profits as well as our assets. Okay, and the IFRS equivalent is called reliability and prudence. It's basically the same you're going to see here. Prudence is a degree of caution in making judgment. As accountants, when you have to make decisions, you want to make them such that you're not overstating or understating your income. Okay, you have to be conservative in your approach. The second one is the consistency principle. This requires that businesses must use the same accounting methods and procedures from one period to the next. Basically, if they're going to change a method from one period to the next, you need to state this to the public, and we call that disclose in the financial statements. An example would be depreciation. We're going to learn how to depreciate our assets later on in the course, in Chapter 9. And there are different methods of depreciation. One's called the straight line method, the other is called declining balance method. And what we're saying here is you need to be consistent. If you're using the straight line method to depreciate your automobiles, you can't suddenly switch to the declining balance method without stating to the public that's what you're doing. And you'll see here that the IFRS equivalent rule is very similar. The cost principle is a very important one that we're going to look at a lot in this course. It means that accounting for purchases, so when you buy assets, let's say, they must be recorded at the cost, the price you paid for it. Okay, so the cost principle, if you buy an automobile for $10,000, it doesn't matter if it was worth $50,000, you record $10,000. And we're going to be talking about that a lot when we do transactions in this course. The IFRS equivalent to the cost principle, the GAAP cost principle, is called measurement. And in most circumstances, assets are recorded at the amount of cash or cash equivalents paid at the time. Again, we use the exact amount of money that is traded for the asset. We do not use market value or what we think the asset is worth. Another GAAP that we need to know is called full disclosure. Basically, any information that is needed to fully understand a company's financial statements must be included with the financial statements. There's a whole set of notes as an appendix to companies' annual reports. So with their financial statements, their balance sheet and their income statement, their statement of equity, their cash flow statement, there's 4 financial statements. With those comes a pile of notes that help the user understand certain decisions that were made or certain methods. For example, the depreciation I just talked about, they would state what method of depreciation they were using. Okay, and the IFRS equivalent is called completeness. And basically they're saying to be reliable, financial information must be complete, and as an omission can cause information to be false and misleading. So not quite as similar as some of the other ones, but basically full disclosure and completeness just say that you must include all the information that is needed to understand, and they're saying don't leave anything out, which may cause you to come up with misleading information. All right, let's move on to the going concern. The going concern, GAAP, basically, as an accountant, you're to assume that a business will continue to operate unless it is known that it is not. And this has a lot to do with the value of the assets. So if a company is going out of business, you know that you will not be selling the company's assets for what they actually are worth or what you paid for them. You're probably going to lose a lot of money. And so if you're doing the accounting for an organization, you need to ensure that you assume the company is going to stay in business and keep the assets at their cost value on the balance sheet. It is also called the going concern in IFRS, and their little blurb is the financial statements are normally prepared on the assumption that the entity, meaning business here, will continue to operate into the foreseeable future. So you're to assume that it's going to operate until you otherwise know different. If you know the company is going to go out of business, then at that point you will adjust to their liquidation value. But until then, everything will stay at cost on the balance sheet. Okay, last page, my favorite, the revenue recognition principle states that revenue must be recorded in the accounts at the time the revenue is earned. It sounds pretty simple, but there are a couple of instances where I can give you a situation where you might question that. So for example, if I cut your hair today, but you don't pay me till next month, did I actually earn the revenue? Do I record that transaction today or do I record it next month? Well, this revenue recognition states that you must record it in the accounts at the time the revenue is earned. So I earned it today, I record it today. Another one would be, an example would be when you get money ahead of providing the service. So companies kind of like Canada's Wonderland, you buy your season's pass before the park even opens. Well, when do they record the revenue? The day you buy your season's pass? Well, they didn't earn it until you start going. So that would be the opposite example. So the revenue recognition states revenue must be recorded in the accounts the time it is earned, not when cash is transferred necessarily. The IFRS equivalent is called IAS 18-revenue, and they're saying revenue shall be measured at the value of the consideration received or receivable. Okay, so consideration received means what is the cash transferred, and transactions are recognized when they occur, not when the cash is paid. So similar, when the revenue is earned, not when the cash is actually transferred. Again, so if I cut your hair today, I earn the revenue today, so you record the transaction today. Not next month when you can't get around to paying me. I'm going to jump right down here to the matching principle because it goes hand in hand with the revenue recognition principle. The matching principle states that expenses must be recorded when they are incurred. So the incurred means it happened. So if I used my cell phone for the month, I've incurred a month's worth of cell phone expenses. And if that happened in July, then I need to record that expense in the month of July. So the expenses must be recorded when they are incurred, not necessarily when I get the invoice or when I actually pay for it. Okay? Another way of looking at that is called matching because it's supposed to be matched to the period in which it helped us earn revenue. So back to that phone example, I used my cell phone to maybe operate my pizzeria, let's say, and so I'm getting the bill for that, and it helped me. The services were in July that I incurred the expense for. Well, it helped me earn revenue in July, so I need to match those expenses with that revenue. All right, last two, business entity. This is an important one. It states that the accounting for a business must be kept separate from personal affairs of the owner. So if I had a Porsche and I also owned a business, I would not put that Porsche on my business balance sheet. That Porsche is a personal asset, not a business asset. Okay, so the owner should not place any personal assets on the balance sheet. And the last one, time period concept, states that accounting takes place over specific time periods, and they're known as fiscal periods. You may have heard the term fiscal periods. fiscal year end or fiscal month end. And the reason why we do that is because our year end, as you know, is December 31st, but not all companies have a financial or fiscal year end of December 31st. My husband's company's year end is October 31st, and lots of government agencies, schools, and whatnot, they have a March, hospitals, for example, have a March 31st year end. So basically, the accounting periods are broken down into equal periods, not necessarily in all cases by the month. They might go every 4 weeks or something like that. So time period concept, accounting takes place over specific periods, and they're called fiscal periods, and the periods are equal length. Okay. So these last three didn't have an IFRS equivalent, but still important to know because in this course we're going to be doing the accounting for sole proprietorships, and we must ensure that we know the GAAP principles. And so by the end of this video, guys, it's important that you, by the end of this course, you understand these GAPs and IFRS and be able to identify them. There's many more, but these are the ones I really want you to know in this course. You need to understand what GAAP means, what IFRS means, and that would be the important part. Understand why they're important too, I would say. Hope this helps, and we'll see you tomorrow.